Well, hello and a very warm welcome to Scope Ratings Cover Bonds Outlook 2026 webinar. I'm Keith Mullin and it's my pleasure to be your moderator on today's session. I'm absolutely delighted to be joined today by Karlo Fuchs and Mathias Pleissner from Scope's Covered Bonds team. Gentlemen, good afternoon. Great to see you. Thanks for being here. Now, in a moment, Karlo and Mathias will take you through some thoughts and perspectives on some of the core underlying themes relevant to cover bonds, including house prices, macroprudential activity, and regulatory topics. Now, rather than presentation mode, we're going to do this more as an interactive Q&A session, with the easy bit coming from me, which is the questions, and the answers coming from Mathias and Karlo. Now, we'll also be delighted to take your questions, so please type these in as we go along, and we'll find time to get to them either during the session or at the end. Now, the full Cover Bonds Outlook deck was published some days ago, but if you haven't seen it, we have made it downloadable from this platform at the end of the session. So that's it from me. We're going to jump straight into it with our first slide. So let me just maximize the presentation. And basically, look, this is the agenda. We'll talk a little bit about bank ratings and outlooks, given that the cover bond ratings are so intertwined with the bank ratings and the outlook. We'll go into some of the specific cover bond collateral, residential, commercial, to a lesser extent, of course, and public sector. Then we'll focus on some of the regulatory topics, including some of the EBA recommendations and, as I mentioned, macroprudential measures. So before we get to the bank ratings outlook here, Mathias, can I just come to you first of all, and can you kind of give us a flavor of the key takeaway for today's sessions from your perspective?
Sure, and thank you, Keith. So kind of the key takeaways for today is certainly that when we look at covered bond markets, then we enter this year from a position of resilience, both on the bank side, but also on the collateral. Bank fundamentals remain quite robust, which is also reflected in the quite stable outlooks of our ratings, but also the real estate markets across Europe have largely stabilized. At the same time, and this I would say is the big uncertainty, sovereign risks and geopolitical tension still remains elevated. So there is an ongoing uncertainty around, for instance, tariffs, but also the aggressive signals from the East, but nowadays also from the West, do certainly not support stability. So that continues to pose a risk to the economic stability and, ultimately, if you wish, also to the covered bonds as well.
Okay, good. So uncertainty reigns, but I mentioned that clearly bank ratings are a very important aspect, or in fact, fundamentally important aspect of covered bonds. So, Karlo, could you take us through some of the topics here that underlie the scope bank ratings perspective?
Sure. And as Mathias already highlighted, actually risks for both, I guess, are kind of similar because both on the bank side as well as on the covered side, we're entering 26 from a position of strength. Clearly, I think 25 has been a very solid year when it comes to the credit performance of banks. We've seen now also the European reporting season starting, and banks really are showing quite good results, and that's actually what we expect, that this is going to provide quite some backwind here for the issuers, that the strong performance seen in 25 is likely to continue. And actually, given that, particularly here on the interest rate side, actually there is more certainty. I think clearly we might even see some upside, because clearly asset quality for the time remains stable. Of course, the pockets of risk that we've seen last year are still around. At the same point in time, interest income is going to remain supportive. And the only thing really that is idiosyncratic to the banks is that they need to watch out to manage the risks, the costs, because clearly one thing that is always increasing is the cost side, and clearly a bank only will be able to have sufficient earnings generation and to be capital generative if they keep the costs under control and don't start loosening up the ties. So we are pretty comfortable on the bank side that here no pressure is likely to arise, and actually we just see that also here, flipping already forward here one slide, you see that actually the majority of the bank ratings that we have on scope, they're currently with a stable outlook. We even have a certain bias, but already a very tiny one, with positive outlooks. But I think again, I think the negatives and the positives are currently weighing a bit more to the positive side.
Absolutely. So a balanced base case, but here's the $6 million question. Just through all of this geopolitical turmoil and stresses, the focus has been pretty much macro political, geopolitical. Do you think European banks are going to suffer from the current geopolitical, let's call them wobbles, for want of a better word?
I think they're well positioned to weather the storms that might be up and coming, but clearly vigilance is important. And I think what was also quite striking is that, you know, we had the slide deck already a while ago, and in here, I think yesterday in the German FSA's press conference, Mr. Branson actually made a very nice analogy, because when it comes actually to the reliance on US dollar funding and the exposure towards the US, he actually highlighted that clearly here in the past, when times had been quite turbulent, you always could rely that the Fed was actually doing what was best for everybody, and there wasn't really a very isolated. But I think Mr. Branson nicely highlighted there is no such thing as an Article 5 in the NATO. So they don't need to do that. And with the current developments, I think clearly here we can't take for granted. And there was also this one book. This time it's going to be different. So yes, of course, we've seen a lot of crisis, but I guess you can't take things for granted these days, and that's why you need to be prepared. For now, I think the European banks are well positioned. If they really don't fall back to idiosyncratic risks that they have hidden below the carpet, I think we're not going to expect a lot of surprises on the bank side.
Okay, that sounds very reasonable. Thank you. We're going to move into some of the underlying topics of the covered bonds on the collateral side. But before we do, Matthias, let me come back to you. Before we kick off on these segments, I want to ask you at the beginning, and I actually forgot. So last 2025 was a very, very big year generally for funding. January's been a very, very active month. We had records across the market in terms of volume. Can you just say a few words on your expectations for cover bond issuance, Euro just on Euro benchmarks, but on a primary issuance for 2026?
Sure. I mean, to make it short, about 160 billion euro benchmark is kind of what we would expect. This is pretty in line with our expectation for 2025, which was 155, while what we have seen during the last year was basically 150 billion euro benchmark issuance. What finally could call for higher volumes 2026, that's certainly driven potentially by redemptions, which are already quite high this year, but even higher in 2027. But also mortgage lending is expected to pick up quite significantly. So also here we might face a positive driver. Then what could call for lower volumes, that aside the geopolitics, which we have mentioned, Could be also the tight unsecured spreads, which honestly may make covered bond funding less attractive, but also relatively high and sticky deficits in many European countries, which again could make covered bond funding less attractive. And then also lower than expected lending growth could negatively add here on the issuance volumes for 2026. At the same time, and I think this also needs to be said, there might be additional issuances from new entrants, but certainly also from retained covered bonds that will never see public markets. But anyhow, I mean, at the very end, and you mentioned that, Keys, we started quite strong with the 28 billion of new issuance in January, which usually tends to be a strong month.
Yeah, no, certainly does. But let's move to perhaps to talk about some of the underlying factors here. And so, you know, obviously residential real estate is the critical one here. So Mathias, I'll let you kind of, you know, perhaps expound some of your thoughts, but if I may, one of the questions that I think perhaps is a more strategic question is, you know, given that housing is perhaps the core collateral for covered bonds, over the long term, has this been a good collateral for cover pools? Perhaps you can.
Yeah. So basically, I mean, the question whether this is a good investment or not long term, and indeed, I mean, I would say so. On the long term, housing remains a very solid collateral basis. So what you see here is essentially the real growth. So house price increases on residential mortgages net of inflation over 15-year long term. And we basically here looked at the performance, at the increase accordingly. And what you can see here is that most European countries actually have delivered positive real house price gains, broadly keeping pace with inflation. But there are some underperformance, like Italy or Finland in that example. So there is a long-term stability, but in combination with relative conservative mortgage lending and prudent eligibility criteria also in regards to the covered bonds, certainly residential mortgages are a reliable and resilient cornerstone for covered bonds.
Okay, but then I guess I'm going to be coming back to this this counterpoint throughout the session. But are there weak spots in the short term?
Kind of, there are, if you wish, and you always might face certain weak spots, of course. So what we did is we did the same, but not only for the 15 years, but for the last 12 months, we were able to observe here. And indeed, I mean, there are some outliers. We talked about Finland just earlier, also on the long term, but also here when it comes to the short-term performance, Finland didn't perform, but also Austria, France, and the UK, which all show real price declines over the past 12 months, so net of inflation. In many of those countries, certainly affordability is an issue, but also construction in the past or demand supply lags might here one of the core driver why we see what we currently see. So if we look at Finland, it's the clear underperformer amongst the European countries in regards to real prices on residential mortgages. They dropped significantly over the last few years. But the main driver here, I would say, is the weak economic environment, but also the surge in construction activity we have observed during the low rate years. And ultimately, the supply is simply outpacing to some extent the demand. So in the short term, we don't think that there will be a meaningful recovery in Finland in regards to the real house prices. Austria is also soft. We have seen a steep run up during the low rate environment on house prices, but also a strong correction lately, which we believe is still kind of adjusting. Also in Austria, we face weaker domestic growth and also oversupply in certain segments of the market. And this, we believe, will continue to put pressure here also on valuations. Right. Looking at France, We also see ongoing real declines. Affordability certainly remains stretched in France. Mortgage credit growth is still subdued. But we also do have the feeling the market here is stabilizing to some extent, so that house prices are expected to broadly are in line with inflation. Finally, looking also here at UK house prices, they are certainly also constrained by affordability and some UK fundamentals. What we observe here is some easing in interest rates, which is positive, but also slow income growth and high debt servicing costs. And this is altogether limiting the scope for a sustained recovery. So that's the position here on those candidates, which are well highlighted by low performance, at least over the last 12 months.
Right. Absolutely. So one of the things that we did do to our viewers here, we actually posted a poll. We posted a poll on social media asking market participants to basically vote on which countries expected to see house price growth going forward. And Mathias, if I could, I'd move to that slide because we've got the results up here. And do you want to give some kind of immediate feedback on this and what this says?
Yeah, I mean, if you wish, this is also kind of about the question, what's up for 2026? And that's kind of what we were asking here in this poll as well. We had only a small selection of 4 different countries and wanted to see what basically the feedback would be from the people here on LinkedIn. So what we can see is that indeed most people expected house prices to outperform increase, followed by Germany, Netherlands, and lastly Sweden. I think what that shows quite nicely is that the expectation on price dynamics across Europe varies quite significantly. So it certainly remains essentially to take kind of a country level view. And that's what we did and what we also shared in our outlook. And if you look at the respective directions, I would have to say that we kind of somewhat match also with the outcome of the poll. I'm not going through all of them here during this webinar, but in case you're interested into some specific analyses, some specific countries, you may have a look into our Outlook presentation deck, which is also covering a slide per country. But overall, for the European area, we expect house prices to slightly outperform inflation. And this is because the sharper corrections we saw have largely played out. House prices in many countries that were suffering some declines bottomed in 2025. And we now expect modest nominal growth broadly in line with inflation going forward. And that's also supported by our expectation on lending growth in 2026. So altogether, the message for 2026 is that mortgage cover pools remain fundamentally resilient. Collateral quality is supported by the conservative lending practices and, of course, also the legal setup and the criteria of covered bonds, including loan-to-value thresholds and strong buffers that basically then supports a strong, let's say, starting point and fundamentals for covered bonds.
Yeah, absolutely. Thank you. So now there's been a lot of focus in the last 2-3 years on commercial real estate. These are clearly a less important asset class for covered bonds than residential housing. But there's been a changing outlook. I think we at Scope have slightly changed our outlook over the cycle. Mathias, how worried should covered bond investors be about commercial real estate?
You mentioned it, Keith. CRE exposures in European covered bond is very limited. So not too worried, to be frank. So average 7% across jurisdictions. That's basically the average CRE exposure. We do see indeed some meaningful concentrations in Germany, Italy, and Denmark. but the vast majority of programs, CAE simply isn't large enough to pose a relevant risk factor. Looking at the broader CAE market, I would say it still remains somewhat under pressure, while, I mean, if we look at the German commercial property valuations, at least this index here, one could argue certainly we see already a stabilization. And indeed, I mean, also Scope expects here a more stable outlook than what we were facing a couple of years before. What matters for covered bonds issuers is more like, or not the issuer, basically the investors, is more like the credit quality or the credit risk from an issuer perspective. So if banks with sizable CAE portfolios face pressure on earnings or refinancing, this can certainly weigh on their issuer ratings and ultimately also affect covered bonds as well. So summarized, I would say the worst is certainly behind us. CAE is worth monitoring also for covered bonds, but not a major concern because simply exposure is limited and well buffered.
Absolutely, makes sense. Karlo, we're going to come on to public sector in a second, but just we do have a question about the exact poll perimeters for the last 12 months. So we're not going to go into that now, but to our questioner, we will circle back to you specifically after the session to give the exact parameters for our poll. I wanted to get to that before we move on. But so back to this public sector issue, Karlo, and clearly, again, I mean, public sector covered bonds are not as common as residential mortgage ones, but can you talk about sovereign risk in this context and whether you think sovereign risk will become more relevant for public sector covered bonds in 2026 and perhaps beyond?
Thank you, Keith. I think relevance of the sovereign ratings for public sector cover bonds, I think we have to distinguish two aspects. The one is that typically for Anglo-Saxon rating agencies, the sovereign rating is also the anchor for what they normally apply as a sovereign cap, that cover bonds might be constrained to a certain number of notches uplift. I think one reminder, scope doesn't actually apply such a mechanistic concept. But having said so, of course, we need to ensure that risks that are out there are adequately factored into the rating analysis. And to that extent, of course, we monitor what's going on the sovereign side. Clearly, I think we see also here that the balance, becomes actually currently more balanced. It's, the risk of going up and going down, it's broadly stable. Majority of our issuers or sovereigns that we do rate have a stable outlook. But having said so, clearly there had been negative rating migrations on the sovereign side. To what extent is that of relevance? It's of relevance, of course, when you look at the development of the credit quality of the cover pools. And when you see here on that slide, actually, it's mainly an issue here for Germany, as well as France, where we see larger exposures towards public sector collateral. Other countries, I think there it's less of an issue. And actually, also to make that a bit more clear, I think when it comes to France, actually here, it's typically not so much really the sub-sovereign exposures. There are a lot of French covered bonds that are more exposed to actually ECA covered bond, to ECA risk, meaning that, export credit agencies that are actually supporting the growth of the economy. So it's not a direct sovereign or sub-sovereign risk they are exposed to. In general, I think we see limited risks for those that actually have a larger exposure um, towards public sector collateral. And I think we also have a sovereign webinar. So if you want to know a bit more about our views here, feel free to look in. But I guess the key risks that Matthias has mentioned that are pertinent for coverts and banks, they clearly emanate here and are the same for the sovereign ratings. It's really geopolitics. politics as such, and not to forget actually the mounting fiscal challenges. And there, I think also here again, the US is in the spotlight. They're currently reloading themselves here with debt, and when in the past the focus on over-indebted countries was mostly here on the likes of Italy, Greece, I think we're seeing really the US now running to become at least uh, a candidate for the second place if they continue their current pace. I think we are going to reach here 140% of GDP by 2030. That's also something that I guess where a changed mindset is going to be needed. But as said, it's sovereign risk for the ratings of the cover bonds coming from a mechanic cap. That's nothing that you should fear from scope.
Yeah. No, absolutely. But from a market perspective, Karlo, I mean, I don't have the data in terms of the proportion of covered bonds that are backed by public sector collateral, but what are your expectations for, I mean, could we see a revival in public sector covered bonds?
Clearly not a revival that we've seen here of the German unification, where clearly at some point in time, public sector cover bonds even dwarfed here the mortgage cover bonds, and were actually the one that actually kickstarted the whole market. If you would have asked me last year, I think a lot of hopes were coming from further defense spending and potentially here that such collateral might make its way into cover bonds. But here we see that most of the sovereigns are taking that on board directly, so there is no need to recycle. So the only expectation where growth could be coming from for public sector cover bonds would be if a more pronounced copy paste from the French blueprint would take place, aka if the economic engine would start kicking again and goods from Europe might be in greater demand, and ECAs become a more prominent role. This is what I would see, that public sector covered bonds could become more relevant. For the time being, German growth projections just have been moderated down yesterday. So I guess we need to see next year and see when I can give you a different answer.
Yeah, okay. All right, a date for 2027 already. Perfect. So look, in the interest of time, perhaps we should move on, because I wanted also to pick up on some regulatory topics, and this gets down to perhaps some of the technical sort of nitty-gritty in terms of policy discussions and potential changes. So I guess, Matthias, talking specifically about the EBA response, there are a number of different sub-themes around that. So perhaps we could go through each of them in turn briefly. And so could you talk about these nominal coverage requirements and what the issue is there?
Certainly, yes. I mean, we might have lost a couple of listeners now because you mentioned we go through each of them, and we certainly won't go through each of all of the recommendations. We picked 4 of them where I think it may make sense to discuss those into a bit more detail. At least here we think, I mean, we might have a spot to touch, yeah. But when it indeed comes to the coverage requirement, what I do understand is that the EBA is keen in harmonizing and like widely implementing a net present value coverage calculation. And talking about coverage requirements for covered bonds, essentially this means how the asset or liability side is sized, or how the coverage of the assets is sized relative to that of the liability. So the main issue is that the nominal coverage, what you see in many legislations today, ignores key risks, especially like market risks from interest rate or maturity mismatches. Take a portfolio of fixed rate, long dated mortgage loans originated during the low rate environment. The present value of those loans today is far below par, simply because their coupon is well below current market rates. But now we see this effect also in reality, for instance, on German mortgage covered bonds, which you see here on the slide, because they are reporting both nominal and NPV OC. So before the rates went up quite significantly early 2023, the average over-collateralization, which was based on net present values, has been significantly higher compared to today's over-collateralization. Today you see, I mean, the NPV and the nominal is quite the same, but it used to be significantly different. And what you see here in the earlier years is essentially the excess spread under a program where the asset side produces a higher coupon on an NPV basis opposed to a nominal situation, which doesn't take into consideration this interest component. So if you look at nominal values, we lose information. We don't see everything. That's because the nominal coverage treats assets and liabilities both at face value and therefore fails to capture potential economic loss embedded in long-dated, low-coupon loans or liabilities. And this is why asking issuers to calculate and publish a present value would add real value for investors, of course, also to rating agencies to some extent, because also public information on interest payments and cover pools is currently very weak. The HTT, the Harmonized Transparency Template, does not disclose interest payments such as the average coupon or the margin of cover assets. So there's basically no direct way to assess a program's real asset value or excess spread. And therefore, we believe it certainly makes sense to take into consideration this element, also considering that currently only 8 out of 24 member states use NPV coverage tests.
Yeah. No, yes, indeed. There's also some discussion around transparency, Matthias, regarding minimum OC requirements. Now, look, normally transparency is typically a good thing, right? But I mean, what's your view on this specific aspect?
Well, the first one, I absolutely agree. Transparency is always helpful. It's always great. And EBA made here a fair point because essentially they were highlighting that they would like to have more clarity, more transparency on how jurisdictions set their minimum over-collateralization requirements. So there are indeed some countries like Germany, Austria, Denmark, and Sweden, for instance, that can apply minimum over-collateralization level as low as 2%. And the justification comes here from the capital requirement regulation. And according to that, the 2% could be used if the asset valuation of the underlying collateral is based on a mortgage lending value. And for instance, in Germany, that's used and also the justification for a lower OC level. But most of the others rely indeed on a standard 5% over collateralization level according to the CRR. And here I was asking myself what might happen now if the new property value in accordance to the CRR3 replaces the market value. So you might remember the property value is another definition within the CRR reflecting a more prudent and conservative valuation methodology. And I was just asking myself whether this means that by applying a prudent and conservative property value, it may likewise justify a 2% over-collateralization requirement across the board, right? I mean, this certainly would add to harmonization. But for now, I mean, we haven't seen legislators signaling any intention to lower minimum over-collateralization.
No, indeed. Okay, interesting. There are lots of other, as you suggested, Matthias, we can't go through everything, but one other thing I did want to ask you was this issue of liquidity and extension. Do you want to just perhaps talk a little bit about that?
Certainly. Certainly. I mean, that's a theoretical construct, but still kind of interesting, right? So at present, some legislative frameworks allow covered bonds to be extended before the issuer enters into insolvency. So this essentially means extensions can be done in order to avoid insolvency of the bank or the issuer. But as far as I understand this as a covered bond analyst, so the principles of extensions, they should kind of come to the benefit of covered bond investors only, right? And serve, for instance, to reduce risks arising from a fire sale of the collateral, assuming the first recourse, the issuer, already defaulted. But anyhow, I mean, the problem mentioned by the EBA is also concerning the 180 days net liquidity buffer, because this is calculated based on the extended maturity. Issuers may face a risk that an extension was executed, but the 100-day liquidity reserve not fully loaded, in particular assuming a situation where the issuer is under distress. As I said, a bit technical, but I mean, the key point I wanted to make is all of these concerns from EBA would basically disappear if extensions were only permitted after the issuer becomes insolvent. And to me, that makes completely sense, because extensions should operate as a risk mitigant tool exclusively for covered bond investors, not for the issuer to manage its own liquidity stress pre-insolvency. Achieving alignment across member states on when and how extensions can be triggered would certainly be a significant step towards harmonization. So we welcome EBA's recommendation, but at the same time, I certainly do have my preference on how all of this could be solved.
Indeed, absolutely. I've got one question that's coming out. It's quite a specific question, which is why is Cyprus marked with a blue point here on the slide 21? Yeah, this we got. Do we need to circle back to our questioner, or do we have the answer at our fingertips?
I'm more than happy to provide this answer at a later point. I think that indeed Cyprus had a minimum over-collateralization level of 10% introduced. But to give the 100% answer, I'm more than happy to come back on that.
All right, perfect. All right. Well, let's talk a bit about some of the macroprudential measures. This is an issue that is I guess more important to mention more often in certain jurisdictions. But Karlo, I think if I may, can I come to you on this? It looks, on the basis of what we've seen recently, it would look as if macroprudential brakes have been easing. I wonder if you could respond to that and perhaps give a reason as to why.
Yeah, I think we see basically this loosening that, however, doesn't really appear across the board as one of the classics, that when pressure on the house prices kind of reduces, that clearly also the focus on what could go wrong actually reduces as well. I think so far, still, I think we see it very prudent that the majority of European countries actually make use, and clear as a rating agency then that looks for risk mitigations. We're always looking forward that risks are as early as possible mitigated. And clearly, the first line here would be at the borrower level, because that's really also where the risks might ultimately appear first. And basically, if you have macroprudential measures, you're shielding, in particular, the borrowers against mishaps if there's a refinancing that takes place at much higher rates, and you're finally no longer able to afford a mortgage loan. That's why we believe debt service linked measures are quite nice. And actually, the most effective loan-to-value measures typically are also reducing the risk, but are not as sharp and targeted. And actually, in most instances, we have a kind of light macroprudential measure already, because that's actually part of the eligibility criteria. I think what we are looking forward to is that the blank spots that we see here on the country coverage, that they're finally going to start to reduce. We see positive noises coming out of Spain that here the recent surge of house prices, where prices go back to levels close to seen at the crisis are actually prompting here the regulators to really very strongly consider. And 26, we expect them to be at least proposed, if not even activated. What always, as a German, I find a bit odd that philosophically here most banks are against such a very targeted measure. At the same point in time, they then have to face actually measures that are rather than on a bank basis. So it's like then shooting here with a big gun on something that where you are actually targeting and hitting a lot, but actually you could go with much surgical approach if you simply want to make sure that the borrowers aren't over levered, and that's why targeted measures actually are much more preferable. And hopefully this common sense always also transpires to the blank spots that we see today here on that map.
Yeah. Okay, cool. So, look, I wanted to perhaps, we're at 40 minutes, so I didn't want to hold our viewers for too much longer. So I thought that, well, why don't we just go to, call it our sort of closing session. And, whether our viewers are investors or on the sell side or whatever they are, what should people be watching out for in 2026? I don't know if you want to maybe highlight the most relevant topics, but it's an open question to either Karlo or Mathias to come in. What are your kind of top three?
Well, I would end this presentation with basically one of the key points I started with. So macro geopolitical risk remain the key driver of uncertainty. That brings implications for the economic performance, the sovereign outlook, issue ratings, and finally also to covered bonds. As far as I'm concerned, the second big topic on covered bonds certainly will be regulatory discussions. It's all about also the recommendations from EBA. That's certainly something which will keep us busy in talking about, while I'm also expecting some news in regards to third country equivalents. And finally, I'm not expecting kind of a material trend shift in regards to the mortgage market. So I wouldn't call this a highlight, but I would like to highlight the fact that indeed, it matters to look into dedicated markets because, as we have seen, there's a strong diversification amongst the performance within the European countries in regards to the respective underlying mortgage markets.
Yeah, indeed. So vigilance. Karlo, what would you add, or do you concur with Matthias's points?
I do fully agree. Vigilance clearly is what is and will remain important. And clearly, I think we're more than happy to share our views on a constant basis to also counter a bit some overweight from our colleagues from the other side of the pond.
Yeah. That is a perfect place to end. So Mathias, Karlo, thank you so much for taking the time and making the effort to give some incredibly insightful commentary on a broad range of topics. Thanks so much to our viewers for staying till the bitter end. I did say that I would give you the chance to download the Cover Bond Outlook, which is, as Mathias referenced earlier, is a much more extensive deck, which has country by country slides for a whole bunch of countries. And so do please download that, give it a read. It's actually a good read. It's in slide format, so it's not full of thousands of words. Any kind of observations or feedback you have on it, please feel free to get back to us. And we always appreciate the interaction and dialogue with market participants. We owe one of our questioners 2 answers, Karlo and Mathias, so we'll circle back on Cyprus and the 12-month poll perimeters. Rest assured, we'll do that as soon as we can. It's a uncertain time out there. So depending on how things evolve, we will certainly come back with an updated session if we think there's enough changes to justify another 30-40 minute session. So thanks again to everyone. Be careful out there, and we will see you next time. So it's goodbye from us.
Thank you. Bye-bye.
Bye-bye. Thanks for attending.